Welcome to the deep dive. If you're trying to stay ahead of the curve in global finance right now, you know that the crypto ecosystem, and specifically Bitcoin, it's no longer a niche conversation. It's a structural component.
Exactly. Today's deep dive is just so critical because we're not just looking at price action. We are examining two seismic structural forces that have fundamentally rewritten the rules of the Bitcoin market in 2024 and well beyond.
We're focused on the halving and the institutional ETP revolution.
That's right. Our mission is pretty clear. Distill the market impact of these two events, the program scarcity and the sudden flood of regulated capital.
And explain how institutional players are altering Bitcoin's cycle dynamics and, physically reshaping the mining infrastructure that secures it. We've synthesized key data from major financial houses like Flow Traders, CoinShares, and cross-referenced it with hard on-chain analysis.
We're really offering you a shortcut to understanding why the phrase, "this cycle is different," actually, holds weight this time. We're moving from the chaos of early retail-driven cycles to an era where institutional flow establishes the floor.
Okay, so let's unpack that institutional flood first. This is really where the story of 2024 begins and where the numbers are just, well, they're truly eye-opening. For years, Bitcoin sought legitimacy.
And 2024 is the year it got it.
Through regulated investment vehicles, the exchange-traded products, the ETPs.
The scale of this adoption is truly historic. We're looking at global crypto ETP assets under management, AUM, surging to $134.5 billion by November 2024.
Just think about that for a second.
That figure represents a 950% increase year over year, almost a tenfold explosion in just 12 months.
A 950% jump in AUM alone signals a huge paradigm shift, but the liquidity followed.
Oh, it did. Global trading volume hit $87.5 billion, which is an 817% increase. But the most staggering shift, the one that tells you who is now, calling the shots, is the geographic realignment.
The U.S. spot Bitcoin ETF approvals in January 2024. They didn't just open a new market.
No, they completely cannibalized the existing global structure. The U.S. now commands an overwhelming 95.2% of global volume.
95.2%. That's not just dominance, that's a centralization of liquidity. So to put that into perspective, what does that mean for the traditional players, like the European funds that used to manage the bulk of this?
It means they're suddenly secondary. The traditional dominance of the EMEA region, which, used to comfortably hold over 50% of the market share, has now just plummeted to 12.8% of AUM.
Wow.
Global crypto liquidity is now centrally managed in New York. And that dramatically simplifies things for large hedge funds and institutional allocators who, frankly, prefer familiar regulated capital markets.
And if you want an analogy for the sheer speed of this, we have to talk about BlackRock's iShares Bitcoin Trust ETF, IBIT.
Right. IBIT became the fastest ETF in history to reach $10 billion in AUM. It achieved that milestone in just 51 days.
51 days. I want you to contrast that with, say, the gold standard of commodity ETFs.
Exactly. The SPDR Gold Shares ETF, GLD, the product that really sealed the deal for institutional acceptance of gold, took 818 days to reach that same $10 billion mark.
So 16 times faster.
Bitcoin adoption through these traditional rails is moving about 16 times faster than gold did in its foundational stages.
That speed just suggests that the whole institutional due diligence phase for crypto it's basically over. They aren't debating the validity anymore.
No, they're debating allocation size.
So what does this aggressive adoption mean structurally? If these regulated products are eating up supply so quickly, how does Bitcoin's institutional footprint compare to gold, its closest analog?
This is where we see the permanent structural difference being established.
Yeah.
So look at the AUM to market cap ratio. Bitcoin ETP's AUM is currently at 3.7% of Bitcoin's total market cap.
Okay.
Now compare that to gold ETFs, which represent only 1.2% of the total value of all above-ground gold.
So Bitcoin's integration into traditional finance is already outpacing gold by triple the ratio. And that's despite gold having, decades more institutional tenure. That makes a huge statement.
It does. And this conviction is boosted by unprecedented technological transparency that's baked right into these new financial products. This is a critical point for any learner interested in finance.
You mean the ETP is leveraging the blockchain itself for transparency?
Precisely. We're seeing things like proof of reserves or POR systems.
So how is that different from a traditional audit?
POR is essentially a real-time cryptographic guarantee. We see Major issuers like 21 Shares integrating these for funds like their core Bitcoin and core Ethereum ETFs. A traditional audit is just a snapshot in time, a quarterly review,
Whereas Porel lets investors verify it themselves.
on-chain, right now. They can verify that the specific digital wallet addresses holding the assets that are backing their ETP shares are correctly collateralized.
So instead of trusting a bank's spreadsheet, you are trusting the math of the blockchain ledger.
That's it. It's forcing the traditional financial system, which relies on trusted third parties, to adopt decentralized transparency standards. We can track the daily flows of BTC from exchanges into BlackRock's addresses using public on-chain data. That's a level of visibility you just don't get in a regulated product normally.
Okay, that sets the stage for massive demand. Now let's pivot from demand to the other structural pillar, supply, the protocol level scarcity event, the halving.
The halving is Bitcoin's fundamental control mechanism. Yeah. It reduces the reward miners receive, the block subsidy, by half every 210,000 blocks. It just cuts the new supply. And the 2024 halving was the fourth of these events.
Right, and we've always looked at the historical cycles, 2012, 2016, 2020, and we've seen these predictable patterns emerge.
Yes, there was a consistent three-phase pattern. A long pre-halving accumulation phase, a speculative run-up, and then the extended discovery and multi-year bull market that followed.
The gains in those earlier cycles were they were explosive. The 2012 cycle saw something like a 7,000% surge post-halving.
Right. But here is the major difference for this latest cycle. The 2024 halving experienced a pretty significant structural anomaly. 1 year after the event, Bitcoin was trading comfortably in the $80,000 to $90,000 range, an incredible absolute price. But in terms of percentage growth, it was actually the weakest post-halving performance on record.
So the market's matured. We're seeing much higher in absolute prices, a much higher floor. But those explosive, chaotic percentage spikes that characterize the early days, they're moderating because the market is just too big now.
Exactly. When you look at popular static models like stock to flow or the power law, they still project long-term growth, but they also show a clear natural reduction in volatility and moderated growth across cycles. The returns diminish as the market cap expands.
But those S2F models, they were often criticized, but they guided the narrative for years. Are we sure we aren't just saying it's different this time because we want to believe institutional adoption trumps everything?
That is the right, critical question to ask. And the answer is that static models that were created during the purely retail-driven cycles of 2012 or 2016 are just insufficient now, not when we have over $130 billion being funneled through regulated ETPs.
So they need to be supplemented.
They must be supplemented with real-time on-chain metrics because of the increasing complexity of the market actors.
Okay, can you walk us through some of those real-time tools that serious institutions are turning to now?
Absolutely. The first is the MVRV Z-score. You can think of this as the market's historical sanity meter. It measures the market cap, what Bitcoin is trading at, against the realized cap, which is the aggregate price at which all Bitcoins last moved.
So if the MVRV Z-score hits the red zone, is that basically the market flashing a sell signal because it's in historical bubble territory?
Precisely. If that Z-score spikes high, it means the current price is far exceeding the average cost basis of all investors. That indicates potential overvaluation, euphoria. If it goes deep blue, it suggests massive undervaluation. It's an indicator that screams, we are entering or exiting a bubble phase.
Okay, and the other one, the spent output profit ratio, SO.
SOPR is a measure of profit-taking behavior. It tracks whether the coins that move today were sold at a profit or a loss compared to when they were acquired. So when SOPR drops below 1, it means investors are realizing losses. That's capitulation. When it stays high, it shows strong profit-taking conviction.
So these two metrics, MVRV and SOPR, they show the real-time intentions of the market. That sounds much more valuable now than just relying on historical cycle charts.
It is infinitely more valuable.
That transition from supply-driven speculation to flow-driven maturity leads us directly to the production layer, the miners. They're the backbone of the network, and the halving directly hits their bottom line.
The 2024 halving created immediate, intense economic pressure. It cut monthly subsidy revenues by over 40%. Dropping from $1.49 billion down to $882 million.
And worse, I assume, the average cost to produce a single Bitcoin skyrocketed?
It nearly doubled. It jumped to an average of $37,856 per Bitcoin, up from about $16,800 pre-halving.
Wow.
And that massive margin squeeze immediately accelerates industry consolidation. Smaller, less efficient miners with older hardware or higher electricity costs were simply forced out.
They had to exit or get acquired by larger publicly traded pools.
Correct. And we saw large pools like Foundry USA and Embody Pool see significant growth consolidating the hash rate.
Mhm.
But the most important consequence wasn't even the consolidation, it was the strategic pivot.
The realization that they were running these vast optimized data centers.
Exactly. It made them perfectly positioned to diversify. So they've begun moving into AI and high-performance computing, or HPC, workloads. They already have the land, the power grid connections, the specialized cooling,
Regulatory approvals, all of it.
all of it.
Right.
By serving AI companies, they secure predictable, high-margin revenue that's totally independent of Bitcoin's price volatility. It's an evolution from being pure Bitcoin producers to being essential, energy-optimized infrastructure providers.
That evolution on the supply side is mirrored by another huge structural shift on the corporate balance sheet side, the rise of the digital asset treasury model, the DA model.
This is really where the scarcity from the halving meets corporate capital strategy.
Yeah.
By September 2025, over 200 publicly traded companies were adopting formal day strategies. They're using equity and debt issuance to accumulate Bitcoin as a primary reserve asset, rather than holding tons of depreciating fiat cash.
Strategy Inc., formerly MicroStrategy, is still the poster child for this. They hold what, roughly 3.1% of the total 21 million Bitcoin supply now?
They do, and they've become incredibly sophisticated about it. In late 2025, they announced a $1.44 billion USD reserve funded by stock sales. This reserve wasn't for buying more Bitcoin, though.
Right. It was to cover their credit payments.
Specifically to cover at least 12 months of their credit payments, effectively insulating their creditors from short-term Bitcoin volatility. They are mitigating counterparty risk to secure low-interest capital.
That's a profound move. It signals long-term conviction, and the market is formally recognizing this new strategy as a legitimate sector.
Yes, the NYSE listing of 21 Capital, or XXI, in late 2025, a pure-play treasury firm that marked the formal emergence of the Bitcoin treasury firm as a recognized financial subsector. Bitcoin is moving from being a speculative holding to a formal component of corporate finance.
Okay, finally, let's place this entire tectonic shift within the broader global economy. Because Bitcoin isn't just a crypto story anymore, is it? It's a macro story defined by global liquidity.
You have to look at global liquidity flows. The price of Bitcoin shows an incredibly tight 0.94 correlation with global M2 money supply growth.
0.94, that's almost 1-to-1.
It is. And M2 is essentially the measure of cash and near cash assets sloshing around the global economy. A correlation that tight means Bitcoin isn't just reacting to its own news. It's a direct gauge of global printing presses.
So what are those printing presses doing right now?
Global monetary accommodation is back in a big way. G20 central banks implemented 54 rate cuts in the last 12 months. That's the highest rate of cuts since the 2008 financial crisis. Global M2 growth is holding steady at 6%. This expansion provides the massive capital flow needed to fuel the institutional adoption we were just talking about.
And on the regulatory front, political shifts seem to suggest the environment is becoming less hostile, at least in the U.S.
The overarching global policy trend is shifting from disruption to integration. In the U.S., the re-election of Trump and a Republican Congress, plus the expected departure of SEC Chair Gensler, suggests a shift away from regulation by enforcement
Towards what?
towards passing the comprehensive, clear regulatory frameworks that institutional players demand. That stability is key. And we're seeing global convergence too. MyCar in the EU, Hong Kong approving spot ETFs for both Bitcoin and Ethereum. It all points to this final concept. Hybrid finance.
Right. Hybrid finance, as laid out in the CoinShares Outlook. This is the collision. Public blockchains meeting regulated capital and finding real-world use cases.
And it's not theoretical anymore. It's operational. It's scalable.
Give me the most compelling practical examples of that hybrid reality.
Okay, look at stablecoins. Their transaction volumes now routinely rival legacy payment networks like Visa and MasterCard. But the real game changer is the tokenization of real-world assets, or RWAs. This is scaling incredibly fast. Major asset managers are issuing on-chain products tracking things like private credit funds and U.S. treasuries.
So they're leveraging the efficiency and 247 settlement of public blockchains while staying inside the regulated perimeter.
You get the best of both worlds, regulatory protection and blockchain efficiency.
So if institutional flows are replacing the wild supply shocks of the past, what does this maturity mean for the top of this current cycle?
Price modeling based on current institutional adoption rates and market phase analysis suggests the cycle top could occur, well, conservatively, in the second quarter of 2025. Looking further out, the CoinShares forecast suggests that if global central banks manage a soft landing while maintaining productivity gains, Bitcoin could push beyond the $150,000 mark by 2026.
That summarizes the massive structural transformation we've seen in 2024 and 2025. The market has fundamentally shifted. It's moved away from purely supply shock-driven spikes, the ones that yielded those 7,000% gains, toward robust, institutional flow-driven trends.
And that new, permanent institutional integration establishes a macro-sensitive floor for Bitcoin. It confirms that the transition of digital assets into the global financial stack is no longer an academic debate. It is operational reality. Bitcoin has successfully transitioned from a fringe challenger to an absolutely essential component of modern finance.
Now, here is the provocative final thought for you to consider as you digest this massive structural change. We've seen hundreds of billions flow into crypto, ETPs, and corporate treasuries, yet these products are often controlled and custodied by a concentrated number of large financial institutions. Think BlackRock and its chosen custodians. So if market access and mainstream acceptance are achieved through this necessary centralization of control over the underlying assets, does that fundamentally compromise Bitcoin's core ethos of decentralization? Or is this institutional acceptance simply the inevitable price we must pay for mass adoption and global stability?